Good morning. This is Derek Peterson with Aviera Capital, and we're coming at you from our new office location in Encinitas, California. There's, surf about 3 blocks from here. There is a lot of restaurants and distractions close by, but we love the location and excited about it. And it's been like 2 or 3, 4 months since construction ended at the college project close to SDSU. And I just wanted to kind of give you a pulse of, we haven't started our new project yet. That's coming very soon. But kind of where my head is at as far as the market in general. And I look at the MLS on a regular basis. I'm always looking at what kind of apartments are for sale in San Diego, and I've seen some price reductions, not a whole lot, based on the interest rate increases that we've seen over the last year. And kind of like the multifamily market is still a bit upside down from that. I mean, prices haven't come down enough. The cost of capital, when I say the cost of capital, I'm saying interest rates. So when you purchase a property, you're probably still looking at a 6 handle, a 6% interest rate. And the cap rates in San Diego right now at this moment are probably right around 5. So, you're still upside down as far as any kind of a spread from what money costs you to your return on investment. You're upside down. The money's costing you at this point more than the return of the asset that you're purchasing. So from that standpoint, it still hasn't come back into a balance where it makes sense to me. I like to at least see on an acquisition day, I'd like to see parity with the cost of capital or thereabouts. I like to see them about even. And right now, we've still got a ways to go. But I mean, the general trend on the pricing for multifamily assets in San Diego have tapered off quite a bit, and maybe a bit of a decline. I mean, there's areas like North Park. I mean, for example, in San Diego, you see price reductions across the board. And there's a lot for sale in North Park, right? They call it no park because there's no parking. But, there's a lot for sale. So, as far as, a future acquisition standpoint, if you can find something that you can develop. Now, Sacramento has given us some very favorable ADU law. We call them ADU laws, but when I say ADU laws, I'm saying basically development laws for building ADUs on multifamily property have gotten really good. You have to know how to navigate it. You need to know how to do your due diligence, but things are, those laws that they've given us through a ministerial process, as opposed to having to go through a full planning and zoning process, is pretty favorable actually for adding density. I would say on the operational side, Sacramento has gone down the road of the Tenant Protection Acts, rent control. These things continue to make operations more and more difficult. And I'm not saying that tenants shouldn't be protected. Obviously, there are bad landlords out there that are doing things that shouldn't be done, and there should be these tenant protection types of ordinances. But they've made it very difficult to operate with what would seem like kind of just nonsensical type of laws for operators to navigate. So once you take your multifamily project, you add some units to it. If you want to operate it now, you get punished. So it's kind of interesting how we're at a standpoint of, Sacramento wants us to densify, add housing, yet when it comes to operating that housing, they'd rather punish. So it's kind of double speak in a way, and but I mean, still, nonetheless, the opportunities are there. I think if you were to look at how much things are going for per door right now, it's about per door of housing unit is about 320, 330 a door in San Diego, something like that in general. Of course, highs and lows depending upon where you go in the county. And now if you were to build ADUs, maybe you're looking at 150,000 or so per door, maybe a little bit more than that. So that spread still makes sense. But if depends on your cost of capital, and again, how well you manage the project. If you're able to manage it to that, 150,000 or so price point, and finish it up at that, as opposed to, there's all sorts of gotchas. As if you watch my videos, I got a lot of that in these projects. So so our next project that we're developing as we speak is in Escondido. It's a project where we ACI bought in 10 years ago. So our basis is pretty low in the project, and so it kind of makes sense at this point to add some units to it. And so we're going to do that, and then we're also going to keep an eye on the market. And like I said, I would like to enter maybe a future acquisition at a point where we have parity between what does it cost to borrow money and what's the return on the investment, about the same, instead of upside down where it costs more for the capital than it does the yield on the investment. Doesn't make sense to me. So for me personally, and I know there's probably multifamily investors that they're not legacy. They are looking to do a quick flip, maybe sell to a bigger fish that doesn't mind the operational headaches. They've got a full team for that, and they don't mind the lower returns either. And if you can buy at the right price, maybe there's an exit there that still makes sense in San Diego. I just personally am going to wait a little bit longer and see what the market gives us as far as opportunity, and and we'll just kind of wait and see. I feel like inflation is going to continue to be a problem. It's going to drive construction up. I think utilities are going to continue to go up like they have been. Insurance is going to continue to go up. All these things kind of make it harder to make these deals pencil out. So we'll have to wait and see, and hope everybody has a great Halloween and a great weekend. Thank you very much.